Imagine this. You're a global company making billions in profits, operating in several countries, yet managing to pay little to no tax in some of them. Sounds unfair, right? This isn't just a hypothetical. It's been happening for years. But now, the rules of the game are changing. Welcome to the era of the domestic minimum top-up tax. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. To understand this, let's go back to a global issue that has plagued economies for decades. Tax avoidance. Large multinational enterprises often shift profits to low-tax jurisdictions through tax planning strategies, leaving countries where the real business happens with little tax revenue. And then enter of the OECD's Pillar 2 framework, a game-changer in the world of global taxation. Here the cornerstone of this reform is the global minimum effective tax rate of 15%. This ensures that large multinational enterprises pay their fair share of taxes no matter where they operate. And one of the most innovative tools within this framework is the domestic minimum top-up tax. So, what exactly is the domestic minimum top-up tax? Think of it as a safety net for individual countries. If a multinational enterprise's operations in a country result in an effective tax rate below 15%, that country can step in and claim the additional tax needed to reach the minimum threshold. The domestic minimum top-up tax works hand-in-hand with the global anti-base erosion rules, or GloBE rules. You should watch this video to understand a little bit more about GloBE rules and how domestic minimum top-up tax works under its umbrella. So, while GloBE rules allow parent companies or other jurisdictions to claim top-up taxes, the domestic minimum top-up tax gives priority to the country where the profits were generated. In other words, local governments get the first shot at taxing income within their borders. Let's simply understand how it works. At the beginning, GloBE rules operate by calculating first the effective tax rate of the multinational group within each jurisdiction that operates in. Then it is comparing the calculated effective tax rate with the 15% minimum tax rate. If the calculated effective tax rate is 15% or above, then no impact should be in place. However, if the calculated effective tax rate is less than the 15% minimum rate, then top-up tax would be payable. And here the next step is, once the top-up tax is calculated, it would be collected as follows. It would be collected by the low-tax jurisdiction itself under the domestic minimum top-up tax. So as we can notice that GloBE rules here prioritize the local jurisdiction to have taxing rights over its own income first. However, in absence of the domestic minimum top-up tax mechanism, then the top-up tax amount would be collected following the remaining tools within the GloBE rules, either by the income inclusion rule or the undertaxed payments rule. At its core, the domestic minimum top-up tax is about fairness and sustainability. It ensures that profits generated in a country contribute to that country's public services, like schools, hospitals, and infrastructure. It's a step toward closing loopholes and making the global tax system work for everyone. The domestic minimum top-up tax isn't just a technical adjustment, it's a bold move toward equity in the global economy. Further videos covering this interesting topic are coming, so like and subscribe if you would like to see more videos, and thanks for watching Tax Gate.